Hello, everyone. Welcome back to another edition of the Weekend Charts. Big show for you this week, so stick around to the end. I'm your host, Charlie Bilello. As always, I'm going to run through the most important charts and themes that I'm seeing today. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. Before we begin, I want to talk about this offer from Creative Planning, my firm. Go to creativeplanning.com/Charlie, schedule a call or a meeting with an advisor today, and you'll receive a free wealth path analysis. And with that, we're going to take a look at your portfolio. We're going to take a look at your retirement plan. We're going to take a look at your tax situation, give you tax suggestions, and we're going to do an insurance and estate planning review, making sure all your documents are in order and your assets are protected. So go to creativeplanning.com/Charlie. Fill out that form today at Creative Planning. We're in all 50 states, so we likely have a location right near you, and we'll have over 300 billion assets under management and advisement. We're here to help. Okay, what are we going to be discussing today? Inflation, the downtrend continues. If we're looking at overall headline inflation, we'll dig into that report, tell you everything you need to know there. The most absurd number in CPI, I'm going to dig into this again because it's just absolutely insane the way the government calculates one of the numbers in CPI. What should and what will the Fed do? So big FOMC meeting coming this week, and I took a poll on X asking what should the Fed do, what will the Fed do, and I'll show you the results of that poll, and I'll give you my opinion, obviously, as well. Number 4, don't try this at home. We got updated statistics in terms of the deficit. Last 4 months, exploding higher, big spending spree from the federal government. Number 5, big tech's incredible run. NASDAQ 100, just an enormous run over the past 18 months. And really the last decade has been the NASDAQ 100's decade, and I'll talk about some of the stats there. Number 6, the watch bubble has burst. Some interesting data there on Rolex watches. Number 7, Americans are falling behind on their bills. Some interesting data there that would suggest perhaps we're going to see a slowdown in terms of consumer spending, and maybe it's already begun. And we're going to end, as we always do, with something positive, and that would be we're back on the path to prosperity for now in terms of wages outpacing inflation. And we got good news in that CPI report with lower food price inflation. I think that was the best data point that I saw. Okay, let's start out with that inflation report, and the downtrend continues. If we're looking at headline CPI here, seasonally adjusted data up 2.5% over the last year. That's the lowest rate of inflation in the US since February 2021. So very good sign that overall inflation is moving lower. That was kind of in line with expectations. We were saying a number of the reasons why inflation was likely to go down. If we look at the comps over the last year, the higher numbers were dropping off, and now we're seeing lower gas prices and a lot of other factors driving inflation lower. If we look at core CPI, which excludes food and energy, that was a little bit of a disappointment. It came in at around 3.3%, so it didn't move lower there. And if we look at the breakdown in the data, here's the really good news. Inflation peaked in the US at 9.1% back in June 2022. And you can see some of the crazy numbers back then, the year-over-year increases were just insane. If we're looking at fuel oil, it was up 99%, gasoline 60%, utilities 38%, electricity almost 14%, food at home, so grocery prices up 12%. This was in June 2022. So we fast forward to today, the August CPI report, 2.5% overall inflation. And now we can finally say this is the first month we can say this. Every single one of these components now is lower than it was in June 2022. And you can see the big difference in terms of a number of these energy prices here. Fuel oil was actually down 12% over the last year, gas prices down 10%, and utilities slightly lower. So good sign there that we're seeing some outright declines over the past year. Even used cars continues to decline, 10% decrease over the last year. Very good sign. Now, why was core CPI a little bit of a disappointment? The big factor driving that was this shelter component, which was expected to continue to move lower, but it didn't. It actually ticked a little bit higher, up to 5.2%. You can see it was 5.1% last month, and that really broke a streak here of consecutive declines in this shelter inflation rate that we've seen over the past year and a half. We've been trending nicely down, and there was a little bit of a tick up there. And you can see just the disconnect between shelter CPI and real time rental data here. Huge spread. So the expectation is this is going to move lower, and maybe this was just a one-off. If again, they're looking at things like owner's equivalent rent, so they're asking people, what would you rent your home out for? So not exact science, obviously. And we saw a little bit of a tick up, but the expectation is that's likely to trend lower in the months to come, and that's likely to translate into lower core rates of inflation as well. So if we're looking at that shelter component, most important component in CPI, over a third of the index, and 29 consecutive months now where we've been above 5%. So that's the longest period of elevated housing inflation in the US since the early 1980s. So if we're looking at one factor that if we're trying to get below 2%, let's say in the next year, one factor that's going to drive us there, well, you're going to need to see lower rates of shelter inflation given its important weight in CPI. Now, not everything is moving lower, unfortunately. If we look at auto insurance rates, they continue to go up here. I'm showing you the 3-year percentage change in terms of auto insurance rates over the past 3 years. 51% increase, just insane increase. We haven't seen that level of increase in terms of auto insurance rates in the US since the 1970s. So that you have to go back over 40 years to get to a point where we've seen auto insurance go up as much as it has. And I'm just going to show you here who's benefiting from that trend. Definitely car insurance companies, Progressive, largest publicly traded standalone insurance company, big player in the auto market. Of course, I think it's top 1 or 2 in the auto market in terms of policies issued. 1,000% gain over the last 10 years versus 240% for the S&P 500. And you can see auto insurance rates up 95% over the last decade. So just minting money are these auto insurance. So hopefully more competition comes in, rates come down, or these increases start to slow, because it's really led to the cost of owning a car and cost of transportation really increasing. So go back to that chart there of the components. Transportation still pretty elevated there at 7.9% increase over the past year, and insurance a big part of that. So what's the most absurd number in CPI? Well, far and away it has to be the US government telling you that the health insurance premiums have gone down 31% over the last 2 years and 10% over the last 5 years. Just unbelievable that they could actually say that with a straight face. And the reason for this is the way they calculate it. Instead of actually using the premiums that people pay for insurance, they're looking at the retained earnings of health insurance companies. And when they go up, they say that this insurance is cost of insurance is higher, and when they go down, which I guess they're saying are down over the past few years, that's leading to a lower cost of insurance. It doesn't really make sense to me, because if you look at the big health insurers, they seem to be very, very profitable. They're doing very, very well. So I don't see how they could be saying that's reflective of what people are actually paying. And if we look at the actual data here in terms of the average US family health insurance premium in the US, you can see crazy increases since 1999. It was 6,000. We fast forward to 2011, 15,000, and today 24,000. That was as of the end of 2023. I'm sure it's even higher today in 2024. So that's a 314% increase since 1999, which is 6% per year. And just to give you an idea how crazy that is, overall inflation is 2.5% per year over that same time period. So far and away, this increase is above what the overall rate of inflation is. And the number one beneficiary of this spike in insurance costs has been healthcare companies. Who's the biggest health insurer in the US? United Health Group up 11,000% since the end of 1999, since January 2000, versus a 479% gain for the S&P 500. So many different reasons, of course, driving this increase in health insurance. I'll cover that in more detail in another episode. But to say that the cost of health insurance has gone down is really an insult to a lot of Americans who are obviously paying more and more every single year, and it makes you question a lot of the data that the government puts out if they're going to continue to use this type of calculation. So they really should try to change this and actually collect the data that people are actually paying for their health insurance every year, which has been, of course, going up and up and up. Okay, number 3, what will and what should the Fed do this week? So big FOMC meeting September 18th. And so I did these polls on X asking what should the Fed do next week? And here's what people said here. Here are the responses. Cut 25 basis points was the number one response. That's 44% of people said that. Then you had 32% saying cut 50 basis points. You got 15% saying hold, and 10% even saying the Fed should hike rates. Now, of course, they're not going to do that. They're not going to hold either. So really the only question is, are they going to cut 25 or are they going to cut 50? And it seems to be here that more people are saying 25. I agree with that. I think they will do 25. So the next poll here, what will they do? And here we're seeing 8% saying no rate cut, 68% saying 25 basis point cut, and 24% saying 50 basis point cut. So a little bit difference here in terms of more people leaning towards that 25 basis point cut in this particular poll. But if we look at what the market expectations are, this is very interesting. You don't usually see it this close heading into a meeting. We're only a few days away here. 50-50 is what the market is saying now. Now, this is going to flip, of course, in the next few days, but 50%, the market's saying 50% chance of a 25 basis point cut, 50% chance of a 50 basis point cut. I talked about in the last few episodes why I think they'll start with 25. I think 50 sends the message that they're far behind the curve. They don't want to send that message, and also sends the message that the economy and employment is worse than people are potentially thinking about. And so why the rush? They could always do 50 in the following meeting or the meeting after if the data gets materially worse. And if we look at all of the other major developed central banks, they all started with 25 basis point moves. None of them started with 50. I think for all those reasons, the Fed will err on the side of caution and start with 25 basis points. But of course, my view is that they shouldn't be cutting rates at all here because overall inflation is still well above that 2% target. So I don't believe in a 2% target means that you're just getting back to 2%. And clearly we're not even there yet. We're at 2.5%, which is great, but 2.5 is not 2. And even if when we get back to 2, we had a few years of way above average inflation, and that's not erased just because we're back to 2%. So you can see here, we're 11% above that 2% inflation trend line. And as long as we're above 2%, we're going to keep adding to this gap between the trend line. So my preference would be to hold off here as long as the economy is doing okay and real wages, as we're talking about later, are going up. Why not keep policy rates where they are? And this is this is showing you what the cumulative effect of those increases have been over the last 4 years. So yeah, we're down to 2.5% increase over the last year. That's great, but that doesn't erase these huge increases over the last 4 years. If we're looking at food prices, 21% at the grocery store, 25% if we're looking at restaurants, electricity costs, 30% higher, home prices, 48% higher, auto insurance, 52%, gas prices, 54%, and so on. So the Fed should still be concerned about inflation here, in my view, because we're not nearly close to erasing what we saw just by getting back to 2%. We're not even there yet. And if we look at core inflation, excluding food and energy, we're still above 3%. So what is the market expecting here? It doesn't matter, in my opinion, of course. It matters what the market thinks, and it matters what the Fed's actually going to do. And this is what the market's saying. They're right there in terms of September. I put it here at 25 basis points, but very close to 50. But after that, the market's saying essentially 25, 50, 25, 50, 25 in the next few meetings. So what the Fed is going to do in this meeting, in the September meeting, is they're going to release its dot plot expectation. And what that is going to say is where they're projecting the Fed funds rate to end this year and where they're projecting it to end next year. Now, of course, this year's projection going to be very important because there's only 2 more meetings this year. So what they're saying is, let's say they do 25 basis points at the meeting this week, and they say by the end of the year, there's going to be the Fed funds rate's going to be 50 basis points below that level after that cut. Well, that would imply, of course, 2 more 25 basis point cuts. But if there's a 75 basis point additional decline based on their dot plots, that would suggest they're going to do 50 at one of these last 2 meetings of the year. And after that, I think you can probably throw it out with in the sense that all of these numbers are likely to be wrong for next year. We just don't know which direction they're going to be. So the market pretty dovish here in the expectation. They're thinking the Fed's going to cut pretty big next year and end 2025 actually below 3%. So to me, that would imply inflation goes down to 2%, perhaps even below it, and stays there next year. Any sense of an uptick in inflation moving in the opposite direction really isn't being priced in here. And I think it's also pricing in that the economy is going to be weaker, that the labor market is going to be weaker over the next year. So if we're looking at other central banks, they continue to cut interest rates. So the Fed is almost the last major central bank to start this cutting cycle here. So the Eurozone, the ECB cutting rates once again last week down to 3.5%. Now Denmark follows the ECB pretty much every time they cut rates again as well. You see Canada has already cut. The UK, Bank of England has already cut. So the Fed stands alone here really in terms of major central banks around the world that haven't cut rates. Sweden already cut, Switzerland already cut. So the Fed expected to join that group. And once again, I'll be a little bit surprised if they do 50 basis points. I obviously don't think there's a need for it, but that doesn't mean they won't do it. The Fed, as we know, always, if there's a choice between being easy or being tight, they're going to choose easy. I just don't think, based on all of the comments that they've had over the past few months and what they said in the July meeting, I just don't think that that 50 basis points is kind of warranted or would go along with that language. And they like to kind of telegraph what they're going to do. So we'll see. Could be an interesting one. We'll see, more importantly, how the stock market reacts to that after that meeting. The stock market had a big week this week, up 4%, pretty much coming back after last week's decline. And you often see that heading into a Fed meeting. They call it this pre-FOMC drift, where stock prices tend to rise heading into a meeting. There's a lot of optimism heading to a meeting. You tend to see volatility come down. And so the expectation is we're going to set off now a dovish cycle for the Fed funds rate. And that's going to be good for the equity markets, it seems like, with the S&P 500 almost back to all-time highs. Okay, let's talk about the federal government. Let's talk about the spending that's gone on over the last 4 months. Pretty remarkable here. Look at the budget deficit over the last 4 months. So this is what the government is spending in excess of what it's taking in over the last 4 months. You got May, 347 billion, June, 660 billion, July, 244 billion, August, 380 billion. Just a stunning increase in spending over the last 4 months. And obviously tax revenues not going up. And so you have this deficit now spiking here to 2 trillion. Very interesting to see that. As I've talked about, there's no real precedent for a US economic expansion and just increasing the deficit the way we've done and continuing to spend as we've been spending. Typically in an expansion, spending, the deficit will narrow, and during a recession, the deficit will increase, but we're still running $2 trillion deficits here in an economic expansion. So the question is, if we do head into a recession next year, as some people are projecting. What is this going to look like? It's obviously going to look like likely even more deficit spending, even more national debt milestones. We're already at 35 trillion. And so if there is a recession, even without one, we're probably going to be at 37, 38 trillion next year. And if we do have one, maybe we're talking about 40 trillion in terms of US national debt. And what that means for the interest payments on that debt, of course, means higher and higher interest payments. We're at another record high through August here, doubling over the past 2 years, the amount we're spending just on interest alone. So this is not at any point where it's becoming a breaking point, let's say, because so far the government just continues to borrow more money to pay interest on the money that they owe. But at a certain point, this will reach a level where it crowds out other government spending, and that could lead to a slowdown. But for now, it's being completely ignored. And the big question will be how aggressive the Fed is in cutting interest rates and how much that will help slow the rate of increase in terms of this chart. Okay, so we have two components, right? You have the debt balance, it continues to go up and up and up, and the interest rates have been going up over the past few years as well. That's been a very bad combination. But now with interest rates starting to fall, will this start to slow down? I suspect that it will. And depending on how much the Fed cuts interest rates, this could potentially start going down again. So, for example, if the Fed were to go back to 0% interest rates, of course, that would be very helpful for the federal government in terms of the interest payments that they owe. So, I think this is a factor as well in terms of the Fed saying we need to start cutting interest rates because this is getting to be problematic in terms of the amount we're spending on our national debt. Okay, I want to talk about the dollar here. You can see trending lower with real interest rates. So real interest rates have been going higher with nominal interest rates and with higher inflation expectations, and now they're falling here. Now you're only compensated, if we're looking at 10-year, 1.6% above it. Still better than what we saw for many years, which was negative real interest rates. So still positive, but interesting correlation here between the US dollar and that real interest rate. And you can see dollar pretty much at its lowest levels of the year. And the expectation, of course, is that the Fed's going to be more dovish. I think that's the main driver of that decline in the dollar. And perhaps this spending issue, this deficit issue, is not helping with that as well. Regardless, the narrative of a falling dollar and increased deficits and increased government spending is actually helping two assets very much this year, I believe. And that number one would be Bitcoin, number two would be gold. And they're the top two assets so far in 2024. Bitcoin up 43%, gold up 25%. I've talked about the biggest driver of gold historically is that real interest rate, and lower real interest rates have been very positive factor for the gold price of gold, and higher real interest rates have been problematic. So there's an opportunity cost when it comes to holding gold. Obviously, you're not receiving any cash flow. There's no concept of a dividend. So the lower the interest you're receiving on competing asset classes like a 10-year treasury bond, the lower the real inflation adjusted yield that you're receiving on that, the better it seems to be for gold historically. Okay, let's talk about big tech here. Incredible run over the last decade. The last 11 years, really unprecedented in terms of the number of strong uptrends that we've seen. I want to show you this table here where we are right now, where this is the fifth longest uptrend in history for the NASDAQ 100. We have data on that index going back to 1986, and it hasn't ended yet. We're still above that 200-day right now, but I just want to call attention to the fact that out of the top five, 4 out of the 5 have happened in the last 11 years. You can see the run from 2016 to 2018 was number one. Then you have 2013, 2014, number two. Number three was 2020 to 2022. And number four was at the end of the 90s .com bubble. And then we have today. So just pretty remarkable that we've been living in this period of very benign markets and just really one long-term uptrend after another. Obviously, that's very unusual in a historical perspective, or we would be seeing a mix of different dates. And really, this is dominated by the last 11 years. And what's really interesting about it is if you take a look at some of these dates in terms of when these streaks have ended, it's kind of marked somewhat of a turning point for the equity markets. If we look at May 2000, of course, the peak was in March 2000. You had a long bear market after that. January 2022, we had the recent bear market that followed that. This October 2018, which was the end of the longest one, we had a quick 20% bear market. In October 2014, that was a pullback in the markets, and then the markets were kind of sideways for the next about year and a half till early 2016. So what happens when this streak breaks could be different this time, but perhaps that will mark a change in the market where you're going to see more volatility and more difficulty. But just appreciate the fact over the last 11 years, this is pretty much as good as it gets for technology stocks and big tech in terms of uptrend. Quick market here. You can see the break in 2014. We went sideways till early 2016. Then another huge uptrend. Then we had that bear market in 2018. Very quick. We came out of that. Obviously, you had the brief period during March 2020 and COVID. Came right out of that. Another big uptrend. 2022 was the longest period below that 200-day moving average. So it was a decent size bear market, decent length. But after we broke back above it, it's just been smooth sailing really since then. So just an abnormal period. You shouldn't certainly expect this over the next 10 years. I would be shocked if we were to repeat anything close to this. Just appreciate how much the NASDAQ 100 has increased and how smooth this ride has been over the last 11 years. And I'm just looking at the last decade here in terms of the big tech players here. Crazy, unbelievable returns. Of course, NVIDIA stands in a class of its own. 26,000% increase over the last 10 years. Got Amazon 1,000%, Microsoft 980%, 923% for Netflix, Apple 886%, and Google down at 440%. So just crazy increases across the board for these biggest companies, unlikely to be repeated, of course, over the next decade. So keep your expectations in check. This is just for a company the size of Amazon to be up 1,000% again would make it the numbers, you can't even calculate what that would mean in terms of market cap. So not going to be repeated over the next 10 years. The question is it going to keep pace with the market? Is it going to be below the market? But what we've seen with technology in the last decade, what we can say is we've never seen this before, where the biggest, most dominant companies in terms of the NASDAQ 100 10 years ago are still there today. And in addition, we have NVIDIA as well. Okay. Quickly, I want to talk about the watch bubble here. This is an interesting chart that I was posting a lot a few years ago in terms of watch prices went crazy during 2020 and 2021, along with a lot of other different collectible assets during that period of time. You had a mania and many things. And what we're seeing since the peak in March 2022, which interestingly, that's when the Fed started hiking interest rates and the air started coming out of watch prices. So this is an index of Rolex watches. They're looking at the top 30 models in terms of a secondary market. So people buy these watches, they collect them. Over time, people say that they're going to appreciate, they expect them to appreciate. But what we saw during 2020, 2021 was just unbelievable. Pretty much a doubling in prices in a very short period of time to 100% increase, which is just, of course, unsustainable. But interestingly here, prices now are down 30% from that peak, and they didn't recover like equities did in 2023 and this year to hit new highs. They've continued to decline in 2023 and still declining right now, and they're actually at their lowest levels now since November 2020. And there's a number of different reasons for that, but biggest reason, of course, as you might guess, is supply is up. So more people are listing these things, and the traders and the flippers of these watches, it's kind of been a self reinforcing process where you bought this thing to flip it a few years ago, sell at a higher price, prices start going down, you start to get nervous, you list that price at a lower price, you take it, and so on and so forth. So what they're seeing is rising supply still. I guess it also must be the case that demand has come down a little bit on these watches as well. But just interesting to see the pullback in terms of watch prices here over the past few years, even though we're hearing that the luxury market in general is doing very well, the high-end consumer is doing very well. We're seeing these prices go down. So just another lesson for investors: when you have just an unbelievable spike in terms of prices, and it's something like a collectible that doesn't have an intrinsic value to begin with, you should expect volatility. And now we're seeing that volatility, 30% decline. I have no idea where this index is going, of course, over the next few years. But the idea that watch prices or art or anything only goes in one direction, which a couple of people were saying back in 2022, saying you want to be in the watch market, it's going to continue to rise. Well, that's, of course, not always going to be the case. If there's going to be upside, you're going to have downside. And who knows, of course, where this is going to go. Could it go down further? Of course, absolutely it could. Or maybe this is the low. Okay, want to discuss falling behind on their bills. Speaking of the U.S. consumer here, Citigroup, delinquencies are picking up. JP Morgan, lower income consumers spending more cautiously. Bread Financial, which serves those lower income consumers, they're saying they expect elevated charge-off rates, and Synchrony, higher charge-off rates as well. And charge-off rates simply, they're writing off the balance because they're saying they're unlikely to pay that back. And we're seeing that in terms of delinquency rates here for credit cards, for auto loans. You can see picking up credit cards at the highest levels we've seen in over a decade in terms of delinquency rates. Obviously not yet near what we saw during 2008, but other than that period of time, we're at the highest levels, trending higher, and it's showing, I think, weakness in that lower income consumer segment. Another way to look at it would be, well, what are people saving today? And if you look at savings rates here, we're seeing the lowest now since June 2022. So interesting to me, 2.9%, by the way. The historical average is around 5.8% here for looking since mid 1990s. Interesting to me that savings rate has gone down even though inflation is coming down. So we talked back in 2022, people were really lowering their savings rates because they had to spend more on prices. And so June 2022, that made a lot of sense. But now we have prices, inflation coming down. You would think that people would be able to save more. That hasn't been the case. So different theories going on here as to why that's the case. Obviously, big factor being all of those stimulus money that we saw in 2020, 2021. Well, that continues to roll off. So that's less of a help for the consumer. And what people are saying is perhaps the consumer is getting stretched because of that cumulative inflation that we were talking about earlier. So just building, whether it's talking about car insurance or health insurance or homeowners insurance rates continue to go up. Cost of things are continue to be higher, even though they're at a lower rate, higher than they were before. And this is certainly hitting a lot of Americans. So we'll see which direction this trends. But this is, other than June 2022, this is the lowest we've seen. You got to go back before the financial crisis to find savings rates lower than this. And last week we saw Big Lots file for bankruptcy. I had talked about the discounters all having problems this year in terms of the dollar stores, and Big Lots files for bankruptcy. Not a huge shock. It was already down huge this year. But if we look at what they're doing here, they filed for bankruptcy and selling to a private equity firm. At least that's the agreement here, as long as someone doesn't come in with a higher bid. 1,300 stores in the U.S., down from 1,425 in 2023. So already obviously cutting back. And you can see the fundamentals have been challenging for a few years here. They lost $205 million in the latest quarter. They only have 44 million in cash. Obviously, that's not going to be sustainable for very long unless they can raise capital or raise new debt, which they weren't able to do. Okay, so if we look at Big Lots here, this is a good lesson for investors in terms of how quickly sentiment can change. See, all-time high was not that long ago following the stimulus and this huge surge in consumer spending. This thing was above $60 a share. Now it's trading at 9 cents, 99.9% decline. And the lesson for investors with any individual stock is that it could go to zero. So, lesson number one, of course, is diversify, diversify, diversify. And there will be many more companies like Big Lots in the future. The only way you can ensure something like this doesn't hurt you is to have a diversified portfolio. And just in terms of sentiment, you could just see how wrong the market was over here. So that's saying, and it's one of my pet peeves, when people say the market is always right. Well, clearly the market isn't right at extremes and at turning points. Clearly, investors who were buying this thing above $60 a share were not right in doing so. It wasn't forecasting better things to come for big lots, and you can just see the reversal since then. Okay, let's end as we always do with something positive, and this is what I call the path to prosperity, and that would be wages outpacing inflation. And what we're seeing here is the lowest food price inflation we've seen in a few years, which is awesome to see. 0.9% increase over the last year. So far and away, the best data point in that CPI report is lower prices at the grocery store in terms of the rate of inflation, 0.9%. As I've said, I'd love to see this go negative here. And so if what we saw over here, 2016, 2017, and before that, I'd love to see it go negative. I'd love to see outright declines in food prices. But this is a good trend nonetheless. And if we're talking about the most important chart in an economy, to me, this is always number one. And that would be comparing people's wages to prices. So how much has your income gone up over the last year versus how much prices have risen? And for 25 consecutive months, we were in a very bad place where wages weren't keeping pace with higher prices. But now 16 consecutive months where we've seen wage growth outpace inflation, 1.3% spread. That's awesome to see. Hopefully that continues. It will definitely continue for at least another month because inflation 2.5% last. I think it's going to continue to trend lower. For looking at all leading indicators and real-time inflation metrics, they continue to trend lower. Here's Trueflation here, 1.06%. They're saying is the current inflation rate, lowest since July 2020. So hopefully that's the case. Hopefully we're trending lower, and that's going to mean more positive real wage gains for American workers, which is over the long term, that's what prosperity means for a nation, is that people's incomes are going up more than prices. Okay, let's end it right there. Thanks everyone for watching. Have a great week. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Week in Charts.